Yeah. Now we have already discussed some of the ratios here in the previous session. Amsika, can you hear my voice?
Yes, sir, I can.
Yeah, and before going into the next topic, see who are the users of financial statements. Can I divide the users of financial statements into two parts? That is like internal stakeholders. See, first of all, the ones who are very much interested to know about the company's financial position are called stakeholders, correct?
Yes, sir.
Who are stakeholders? Stakeholders are the connected parties to the company. I'll write here connected parties. Connected parties with the company. So stakeholders are the connected parties with the company, correct? So stakeholders we can divide into two parts: internal stakeholders, external stakeholders.
Yes, sir.
So who are the internal stakeholders? Internal stakeholders are the ones who are like the ones who are connected with the company, but internally. That means they are the integral part of the company. They are the internal part of the company. For example, board of directors, for example, the management and the employees, correct?
Yes, sir.
And who are the external stakeholders of the company? The external stakeholders of the company are the shareholders, the creditors,
Sir,
banks.
your screen got paused, sir.
Just a
I
second.
can't.
Yeah, can you see the screen again? Please confirm. Can you see the screen again?
Yes, sir.
Yeah. So the external stakeholders are shareholders, creditors, banks, customers. Then we can say government. Then we can say the next one is the
Suppliers.
yeah, suppliers are creditors. We can say NGOs or pressure groups or political parties.
Okay, sir.
So these are all the stakeholders of the company and what they want. They want to know about the company's performance in all the respective areas which I have which I have discussed in the previous session, correct? They want to know about the company's liquidity position. They want to know about the company's solvency position. They want to know about the company's profitability, overall profitability, turnover, everything. They want to know everything about the company because they are the stakeholders. They are connected with the company. Okay. Now,
Yes.
the activities is what I will leave on you. Simple activities, not the calculated ones. This you can do. So first activity is the homework. Okay. Now, what is this analysis of financial statements? See, analysis is nothing but it's a study of financial statements. It's comparative study, in-depth study. Each and every aspect is to be studied under the analysis of financial statements. So if you are presented with a set of accounts, you should make a note of all the obvious trends or changes in the figures before calculating any ratios, correct? That means you have 2004 figures and you have 2005 figures. Let's say we had a cash balance of 10,000 and now we have a cash balance of 12,000. Do you think there's an increase in cash here? Please tell me.
Yes, sir.
Of course. So like this, we have to see many things: increase or decrease in revenue, increase or decrease in cash balance, issue of shares during the year. We have to check like what they are saying. You have to check some figures and you have to compare the current figures with the old figures and see the increase or decrease in that, correct?
Yes, sir.
Then increase or decrease in non-current assets, increase or decrease in receivables, inventory, which is like not justified by increase or decrease in revenue. Of course, when you do credit sales, you show that credit sales as a like in the income statement, but you show the receivables in what? In the balance sheet. Am I right?
Yes, sir.
So you have to see that in separation, increase or repayment of loans during the year. That means you have to check all the elements, all the items which you are showing in the statements, and you should investigate, you should do a detailed investigation of that matter, like how the increment has happened, and like previously what were the figures and today what are the figures, correct? That will show the company's performance in the current year when compared to the previous year, isn't it so?
Yes.
And then comes the ratio analysis. In that we have already discussed about the profitability ratios. Gross profit margin is done, operating profit margin is done. And right now we are going to discuss about the return on capital employed. Okay, ROC. Now,
Okay.
see, first of all, we have discussed yesterday that revenue minus COGS is gross profit.
Yes,
Less
sir.
operating, administration, and selling
Selling.
expenses gives you what? Operating profit, correct?
Yes, sir.
This operating profit is also called as PBIT. Am I right?
Yes, sir.
So you are taking this PBIT here in the numerator to find out
Okay.
the return on capital employed. To find out the return on capital employed, you have to take PBIT, correct?
Yes, sir.
Why you have to take PBIT? I'll explain you. See, PBIT by capital employed. See, capital employed is nothing but you can take the capital employed in two ways. How you can take is, first of all, capital employed means all the types of capitals which are utilized in the business. So what are the capitals which are which are like utilized in the business? Can I say that is equity share capital? Can I say that is equity? Total equity?
Yes. Yes,
What
sir.
do you mean by total equity? What comes under total equity? Let me be very clear. Total equity is, see, we have not discussed about balance sheet many a times. We have only focused on the income statement, correct? So a balance sheet also is what? Let's see the balance sheet now. So of course, many of the students know what is balance sheet. So previously we used to make T-shaped balance sheet. Okay, like we used to write assets here. We used to write liabilities here. Liabilities in the sense this is not liability side only. This is liability and equity side, correct? So what comes under asset? Current assets, non-current assets, and here comes the total of assets, correct?
Yes, sir.
And here what used to come? You used to take what here? You used to take equity. What comes under equity? Share capital, retained earnings, correct?
Yes, sir.
Is it so? Yeah, retained earnings. And what comes under equity? Can I say revaluation surplus? Share premium? These are all part of equity. Am I right?
Yes, sir.
So these all are equity. Okay. So if you want, and then after equity comes the debt. Debt. And under debt comes long-term debt. Long-term debt is what actually long-term liabilities. Okay. Like debenture, like bonds and all. Bonds or debentures or anything which are long-term loans you can take. And then comes this is debt. Then comes the current liabilities. Am I right or wrong?
Yes, sir. Right.
Then this is nothing but total of equity and liabilities. This is a right statement and right statement to make. Now, when it comes to capital employed, we are taking what we are taking all those capital which we utilize in the business. So we'll take total equity. Total equity is this part. This entire thing, what we are taking here is total equity. Okay. Okay. So
Yes, sir.
what part is coming under total equity? Share capital, retained earnings, revaluation surplus, share premium, etc. And then we will add debt to this. Okay. So this is like which debt? Long-term debt, not the current liability. In some cases, some of the analysts, they also take current liability. That means they take this entire thing, but no, ACCA is against that kind of notion. ACCA is very clear in their approach that if you are speaking about capital, the capital can be only considered as long-term capital, and the long-term capital can be either debt or equity. Am I right?
Yes, sir.
Yeah. Suppose if you want to buy a car, this car is like costing you 10 lakhs. Okay. And in this, when you bought this car, you have made a down payment of 2 lakhs. And rest of the 8 lakhs is what? Debt. Am I right?
Yes, sir.
This is the loan which you take. So what is this 2 lakh called? Equity. The money which you put from your pocket is equity.
Okay. Yes, sir.
Yeah, of course. So this is equity, this is debt. If someone asks you a question, that this car you bought and how much, like you are the owner of this car, like you own this car to what extent? You simply say, like some people who don't have an idea, they say, this is my car, I am the owner of this. No, you just own 20% of this car because your equity is just 20% and your debt is 80%, correct?
Yes, sir.
So can I say this equity and this debt is nothing but capital employed? Of
Yes,
course,
sir.
equity plus
Yes,
debt
sir.
is capital employed. This is the capital you have to put. How? One, you have invested. One, you have taken as a loan and invested. Okay. You made a payment of 10 lakhs to the dealer. That is for sure. Some part of the payment you made from your pocket, some part of the payment you took from the bank and you made the payment. You definitely have invested 10 lakhs, but these are two different categories of, this is the two different ways you have invested your money. Am I right?
Yes, sir.
Next
Sir,
question is, yes,
sir,
yes,
could
yes,
you
tell me, Hamsika.
sir, could you explain me those terms, sir? Share capital, retained earnings, and revaluation surplus.
Yeah, why not? I thought you know this. Okay. See, share capital is simply the equity which I explained you. The down payment you made na 2 lakhs.
Yes, sir.
See what happens when a company, when someone wants to start a company, they require funds for that. So there are two
Sir,
ways
your
they can arrange the
screen
funds.
is paused again.
Oh my God, again, just a second. Can you see the screen once again?
Yes, sir.
Yeah. So there are two ways. See, if you are starting a company, Hamsika, to start, you require funds for that, correct? There are
Yes, sir.
two ways in which you can arrange the funds. One is through equity, one is through debt. Very simply understood. Debt is something which you borrow. It's your borrowing. But what
Yes.
is equity? Equity is something which you have to put money from your side. Or if you don't have money, suppose the capital what you require is very high, and you cannot put the entire money as a capital in the business. So what will you do? You will approach people for that, correct? You will
Yes,
you
sir.
will try to gather investors for that. And why will investors come to invest in your company? Because they see prospects in your company. For them to take ownership rights in your company, what they will buy from your company?
Shares.
Shares. These shares are nothing but these are the holdings what you are giving to them. For example, your company requires 10 lakhs of capital, and out of that 5 lakhs have been like arranged in form of debts. So rest of the 5 lakhs company has to arrange. For that 5 lakhs, what company will do? Company will issue shares to people. That means company will give them holdings in the company. Correct?
Yes, sir.
They will sell these holdings to people. Sell in the sense, if I want to invest my money, I have to buy a share certificate from the company. Suppose in this I just purchased completely, let's say 2 lakhs. That means I bought 2 lakhs worth of shares in the company. So my investment is 2 lakhs. I'm a shareholder. So in this company, out of the total 10 lakhs capital, how much is my equity? 2 lakhs,
2
correct?
lakhs. Yes, sir.
Like that, 3 lakhs more has to be arranged. For that, some more people will buy the shares of the company. So in this way, company is arranging the capital for the company. Capital is a general word, but capital can be in two forms. One is in the form of equity and one is in the form of debt. So equity here is of 5 lakhs. That means 5 lakhs shows the ownership of various shareholders in the company. That means this company has 50% shareholders capital, and 50% company has arranged money from bank by taking loans, correct?
Yes, sir.
But why did they do that? Because they were not getting all 10 lakh rupees. Like people were not buying the entire 10 lakh rupees worth of shares. Maybe they were just buying 5 lakh rupees worth of shares, correct?
Yes, sir.
Yeah, because companies can have, there can be any capital structure. For example, this is a company. Either this can be all equity company. That means the entire 10 lakh rupees worth of money company will get by selling shares to people. Okay. Someone will buy 2 lakhs worth of shares. Someone will buy 3 lakh worth of shares. Someone will buy 5 lakhs worth of shares. Someone will buy 2 lakhs worth of share. So the individual who is buying 2 lakh worth of shares is 20% owner, 30% owner, 50% owner, 20% owner. Can this happen?
Yes, sir, it can.
This can happen. Second one is all debt company. That means they are not getting funds in any ways. That means they tried their level best to issue shares to public, but people are not ready to buy this company shares. Why? Because suppose this company is a startup. They don't have that much of exposure in the market. Understand? In the sense, they have not been in the market for a very long time. They are a very new company. So do you think people will believe in new companies?
No, sir.
Never. See, it's very risky. Zomato came out with IPO, but after a very long time, after convincing people that they are a stable company, but what happened? IPO to that Zomato's IPO, immediately the shares fall, shares value fell down, correct? So some company which is of likes of Tata or in India or some Reliance or some companies of such repute can only get money in the form of equity because people will blindly invest in such companies, correct? So
Yes, sir.
if not equity, then all debt. Third, either in the form of equity or in the form of debt. That means combination of equity or debt. Sometimes 50% equity, 50% debt, sometimes 60% debt, 40% equity, anything. It can take any combination. Okay.
Yes, sir.
You understood what is share capital. Now coming to retained earnings. Now I'll take it here. See, share capital is done. Now coming to retained earnings. See, retained earnings is what you should understand. See what happens. Company every year, let's say company is earning profits. When company earns profits, it has to accumulate that profit, correct?
Yes, sir.
You cannot waste your money if you see a company is a responsible organization. So when company is earning profits, those profits have to be used by company for some purpose, in the sense for some investment purpose. Why? Because the profits the profits what company earns belongs to whom?
Uh, belongs to the people who will
Shareholders.
invest it.
Shareholders.
Yes, sir.
They are the owners of the company. Okay. So I need to give you my first chapters video today, basic video, because you lack a lot of concepts. So I have already finished that chapter. I'll give you that video so that you can understand what is the difference between company, form of organization, what is share, what is everything. Okay. So
Okay,
have
sir.
you gone through those ledger accounts videos?
Yes, sir, I have.
How many videos?
So I've gone through 3 videos.
Okay, you understood, not till third video, everything.
Yes, sir, I did.
You are very much clear with the concept, correct?
Yes, sir.
Yeah. So, see, shareholders, see, the company belongs to shareholders. So whatever the profits the company earns, those profits belong to shareholders. It's very well understood fact. Okay. Now, suppose the profits of the company are 1 lakh rupees. Okay. So what the directors will do is, directors will give an offer to shareholders. See, we have got a profit of 1 lakh. If you want, we will share this entire money with you. But instead of that, it is better that we give you some part of this money, let's say 10% of this money to you. That 10% or this 10% part of the profit is called as dividends. What is it called?
Dividends.
Dividend. So dividend is nothing but a portion of profit which is to be given to shareholders, or which is to be distributed amongst the shareholders. So that portion of profit which is to be distributed amongst the shareholders is called dividend. Okay. Because why the company is giving dividends to shareholders? See, something company should give to shareholders. Otherwise, shareholders will not be motivated. Am I right? See, if you
Yes.
are not getting anything every year, you will not be motivated. Am I right? So if dividends are given
Yes.
by the company to shareholders, that's an indication that company is making good profits. Okay. Now, rest of the amount, what company will do? Definitely company will accumulate this amount and look for very good investments. Okay, like they can try to expand their own, they can try to expand themselves. That means they can start a new branch somewhere, they can try to acquire some other company, or they can start a new company. They can do that, na?
Yes, sir.
So that money they have to keep somewhere. That money they keep in this account called retained earnings account. Okay.
Okay.
And whatever they accumulate the profits in this retained earnings, they will utilize for reinvestment. What is that?
Reinvestment.
That they will invest. Okay, so that is retained earnings.
Yes, sir.
Third point, yeah, revaluation surplus and share premium. Can you give me a second time? I'll have some water and come.
Okay, sir.
Yeah, 2 minutes, Amsika. Yeah. So, yeah, so what they will do is reinvest. Now, next point is revaluation surplus, correct?
Yes, sir.
So revaluation surplus is nothing but, suppose you bought a asset, a land or a building. Suppose you bought a land. No, let's say not land, building. You bought it for $100,000 and you are depreciating it at the rate of 10% straight on straight line basis. So you get 90,000, correct? So what
Yes, sir.
happened? Again, you got 80,000. So what happened is after 2 years, what happened? You wanted to know what is the value of this building in the market. We usually see na after 2 years whether the value has come down or come up. Definitely in the books the value is less. But do you think in the market also the value would be less? We can't say that, correct?
Yes,
It's
sir.
tough to say, na? It can be high also, correct? So
Yes.
when we revalued this building through a revaluer, he said someone like we got to know that we are getting $120,000 for this building because of high demand and because of the prime location, let's say. So what is the gain in this? How much? $40,000. How much is the gain?
$40,000.
That $40,000, whatever the gain you have got through revaluation is called revaluation surplus. And this revaluation surplus is nothing but some profit, which is a profit, okay, or income, but a unrealized nature income. What do you mean by that? Unrealized nature income. Why did you sell this property? Did you sell this property?
In the last we did.
No, we did not do now. We just revalued. We did not sell it. We just came to know the value is 40,000. But we did not sell this. If we would have sold this, we would have got 40,000 profit, and that would have been called as profit on sale of asset. And
Okay, sir.
profit, yeah, and profit on sale of asset is a realizable nature income. It's a realizable nature income. Since it's a realizable nature income, it comes in the statement of profit or loss. Where it comes?
Statement of profit and loss.
Something which is not of realizable nature and still it's a income will not be a part of income, will not be a part of statement of profit or loss. That has to be shown in the other comprehensive income section. Which section?
Other comprehensive income section.
This other comprehensive income section comes after the net profit. So this is revenue less COGS. You get gross profit less all expense, add all incomes or other incomes less all expenses. You get net profit. After getting net profit, you take OCI section, other comprehensive income section. Why you are taking this OCI? Because there are some incomes which cannot be shown in this statement. Why? Because they are
unrealizable in
nature incomes. So such kind of incomes can only be shown in this. And from here they will go to equity, because you know all the incomes have to be again transferred to either retained earnings account or either equity. Am I right?
Yes, sir.
See, I told you right now, equity is not a small thing. Total equity is a combination of share capital, retained earnings. So this net profit is transferred to this account. Okay. This, suppose my net profit is $100,000. So if company is declaring 10% dividend, so company will deduct 10,000 from this. Leftover 90,000 is again where it is to be retained in this account only. Am I right?
Yes, sir.
And this again I told you some more things. Revaluation surplus. So whatever I show under OCI, so my building has got revalued by 40,000, correct?
Yes, sir.
So that is called revaluation surplus, and again that will be shown under equity also in balance sheet. Okay, as revaluation surplus 40,000. So I'll clearly make a note of this. There are two treatments now. One is
revaluation. So in the revaluation surplus, we don't sell anything. We are just.
We are just revaluing. Yes. So still what is happening? There's a gain, and shareholders will ask that this gain we okay. I can understand that we are not selling this and we are not realizing any money out of it, but still it is a holding gain, na? So holding gains should also be shown. Why? Because when you revalue the property, see, listen here. There are 3-4 treatments here. One is the statement of profit or loss. One is the statement of financial position. So now this year what will happen? This is liabilities and equity. This is asset. Okay. So your asset was how much now? Buildings? Your building was of 80,000. Am I right?
Yes, sir.
You got a surplus of how much?
40,000.
Add revaluation surplus. So now you have to show your asset at revalued amount. Now this is the actual amount, correct or wrong?
Yes, sir.
There are two models actually. There are two models. You will be learning that in the tangible assets chapter. You can show your asset in two ways, either at historical cost or at revalued amount. At revalued amount. So if you are choosing to show your asset at historical cost, you will show at 80,000 only. But the recommendation is if you show at revalued amount, it is better, na? Why? Because that shows the clear picture of the asset. Am I right? What the asset is actually in the market right now. You are showing that actual thing. Is there anything wrong in this? No, there's nothing wrong, because the IFRS, International Financial Reporting Standards, allows you to do that. Okay. Okay. So this is the balance sheet side treatment. Now, you know, our balance sheet should tally. Since I am showing this in the asset side, something has to be shown in this side also, no? Yes, liability side, and liabilities are equity side, correct or wrong?
Yes, sir.
So I will show my share capital some amount, and I will show my retained earnings some amount. Okay. And I will show my revaluation surplus under equity as 40,000. Correct?
Yes.
But everything, whatever you show under the share capital comes from SOPL. So what we will do, we will take revenue less COGS We'll get gross profit. See, this is all financial statements also I'm teaching you. Add other incomes, less all expenses, let's say. And then you get net profit, and this net profit will be transferred to this account. Then comes OCI section. Under OCI section, I showed revaluation surplus as 40,000, and that again will be transferred to this account. Understood?
Yes, sir.
Yeah, that is what is the treatment. So now,
Okay, sir.
yeah, because revaluation surplus cannot directly be shown in the equity, it will go via OCI only. Okay, first we have to show there, and second we have to show here.
Yes.
Next point. Just a second. Yeah, let's go ahead. We were into
The balance sheet, sir, of ROC.
yeah, we were into ROC. I really lost my track where I started and where I gone. Yeah, now we were into ROC. Okay, again I have to recollect from where. Okay, okay. Okay, I'll just write on the formula there. No problem. I like it doesn't matter for me to see in the yeah. So we started with ROC, right?
Yes, sir.
Yeah, let me put that here. Yeah. So we started with ROC, that was return on capital employed. The formula was PBIT, profit before interest and tax, divided by total equity plus long-term debt or long-term liability. Am I right? So I said total equity has many things: share capital, then comes retained earnings, then comes revaluation surplus, and then comes share premium. Okay, so I did not explain you about share premium. So let's say share premium is nothing but, suppose we are issuing 50,000 shares to people, correct? Okay.
Yes, sir.
And per share price is $1. Fine. So we got $80,000 when we issued. So actually we should get how many dollars? $50,000, but we got how much? $80,000, correct? So 30,000 extra what we got from the shareholders is nothing but share premium. So that premium again should be redeemed or given back to the shareholders. Okay, we are not going to go in deeper into that. That's not there for you. Just I'm giving a information.
Yes.
Now comes long-term debt. Okay, long-term debt is long-term loans which the company can take from banks, or they can issue bonds to people and raise money in that case. Okay, for that I will give you that video, the video of first chapter, whereby I have discussed about what is a bond with my student. So you'll very easily understand about that. Okay.
Okay, sir.
But you understood now what is a what bond or debenture or long-term loan? You got some idea, correct?
Yes, sir, I did.
It's a security which see, if you want to take this is a bank and this is you. If you want to take a loan from bank will tell you, we will give you loan. Of course, we are existing for that, but you have to deposit something with us. That something with bank is nothing but you have to give them some security, some gold or your property documents, anything. So they will give you loan for that after taking that, correct? Hello.
Yes, sir. Yes, sir.
Of course, that is a condition. You have to mortgage your property for getting a loan. Now, now in this case, let's say this is bank and this is you. Bank wants money from you now. This is bank which wants money from you. So bank, when it wants money from you, then you will also put a condition like give us some security, then only we'll give you money.
Yes, sir.
So what bank will do is bank will see how much assets they have. So bank has assets of, let's say 10 lakhs. So bank valued all their assets And what bank has done is they have divided this 10 lakh rupees worth of assets in $1,000 bonds. What did they do is 10 lakhs divided by $1,000. So they issued 1,000 bonds to people. How many bonds?
1,000 bonds.
And each bond, this is a bond. Each bond is of how much rupees? How much dollars? $1,000.
$1,000.
And what's the precondition in this bond? I am liable to pay the bearer means the holder of this bond, $1,000. Okay, after 5 or 10 years, they will decide the maturity date also. That means when you take a loan from bank, you'll be also taking some time, not 2 years or 5 years. Until that time, bank will charge interest from you. In the same way, when bank is borrowing money from public, so what public will do, what bank and public will agree for something. What they have agreed is the maturity period will be 5 years. We will give you the money for 5 years only. Till that time, you have to pay us interest. Correct?
Correct, sir.
But how will we understand what is the guarantee that bank will pay money? Of course, in every bond, it will be clearly mentioned that this particular bond, which is of $1,000, carries the see the assets were of how many lakhs? 10 lakhs, correct? So what they did is they divided that 10 lakhs into 10 lakhs valuation, whatever the assets they have, they divided into 1,000 bonds. So all the bonds will have that 10 lakh rupees worth of asset ka backup. Am I right?
Yes, sir.
But not exactly like that 10 lakhs is now divided into 1,000 bonds. So every bond will have a backup of $1,000. That means $1,000 worth of assets are backup for these bonds. Okay, that's what.
Yes, sir.
So now they will sell this to public and take money from them and then pay interest till the time they repay them. That is what is the concept of bond.
Sir, so only banks can issue bonds, sir?
No, companies can also do that. No? Many
Okay.
companies can do that. Yeah, companies can also do. My God, we discussed this much for all this. Okay. No problem. See, your basic should be very strong for the class. Now, the final thing, why are we taking PBIT here? See, now this is the most important concept. This PBIT is also called as operating profit. So, first and foremost thing is equity holders want what? Profits, correct?
Yes, sir.
And bond holders want what? Interest. Correct? This PBIT, which is also called as operating profit or operating income. Okay. This operating income is the income from which company can pay to bondholders their interest, and leftover profit company can distribute amongst shareholders. Am I right?
Yes, sir.
Since profit and interest both are important for these two parties, for this party profit and this party interest, we are taking operating income, because from operating income only we can pay the money to bondholders or the liability holders or the long-term debt holders. Correct?
Yes, sir.
Of course, if company has to pay interest, it cannot pay from net profits. It can pay only from operating profits, because PBIT, from PBIT only if we subtract interest, we get PBT, and from PBT when we subtract tax, we get PAT. Am I right or wrong?
Yes, sir, right.
That's the reason why we are taking PBIT in the numerator. So many a times students will be confused, why not PAT, why we took only PBIT? Why? Because PBIT is operating income. From operating income only you can pay the interest to bondholders. Okay, and then like whatever is left over, you will be paying to equity holders. Now, very simple interpretation of ROC. Suppose my operating income or PBIT is $10,000. Okay, and my capital what I'm investing is 100,000. Correct? So what is the meaning of this ROC? I invested how many dollars? Okay, no. Okay, yeah. I invested how many dollars?
$1 lakh.
Let's cancel this to get more clarity. I invested $10 and I got how much profit?
$1.
Okay, that means 10% of the profits. Or if I say something like this, I invested $1 and I got how much?
10
Can I say?
cents.
Can I say this?
Yes, sir.
I can say this. So ROC, what ROC says is for your investment in the company in like in whatever capital form it may be, whether it may be a combination of debt or equity. See, if this particular question I'm taking and capital employed, if I'm taking debt plus equity plus debt, that means my company is having combination of equity and debt as capital, correct?
Yes, sir.
Sometimes it can only be debt, sometimes it can only be equity. So what I mean to say here, when I am starting a company and I'm investing $100,000 or if I'm investing $1, I'm getting how many cents?
10 cents.
10 cents, correct or wrong? In this
Yes, sir.
case,
Correct.
see, my profit is how much? Okay, let's say my profit is 10 rupees, $10. My investment is $100. So on $1, how much cents I'm getting?
10 cents.
Why? Because my out of my investment, whatever I've done, I have got a profit of 10% from my investment. Correct or wrong?
10%.
That shows
Yes,
on
sir.
$1 I'm making 10 cents. Very simple.
Yes.
It is good or bad?
Sir.
No, asking. I'm asking whether this is good or bad.
Sir, I think we can earn more.
See, on $1, no. See, again, that is a big issue. For profits, there is no standard. Okay, profits are purely relative measures. How? See, there is no satisfaction for this. As you said, yes, sir. If I would have got more, I would have been more satisfied. Correct? You are saying that only, na?
Yes. Yes, sir.
But my point is, you are absolutely right. If you would have got more, you would be more satisfied. But how to conclude that this is a good profit for us or not? Previous year, I earned 8 cents from $1. This year,
Okay.
I earned 10 cents from $1. Previous year, my profits were 8,000. My investment was 1 lakh. So on
Okay.
$1, I made 8 cents. This year, my profits are 10,000 and my investment is 1 lakh. So on $1, I made 10 cents. Which is better? This is better.
Sir,
Correct?
this year. Yes, sir.
Correct or wrong?
Yes, sir.
Yeah. So this is the interpretation of ROC. Yes.
Sir, so we always compare profits with the previous year to know if a company is doing better or not.
Yes. Profits are never an absolute measure. They are always relative measures.
Okay.
So where are we right now? ROC. Correct?
Yes, sir.
Just a second. But where is this ROC? Yeah. So this was about ROC. Shall we continue the next session tomorrow?
Yes, sir.
Yeah, it's almost 9 now. So tomorrow we will actually I came early only today, but I said no, I had a birthday, so beside my house. So tomorrow we will start at 7:30. We'll take till 9. Why? Because other students are also not present today. So tomorrow we'll cover up return on equity, current assets,
Okay,
current
sir.
liability. This current ratio, quick ratio is done. We will start with this efficiency ratios. Okay. So tomorrow's target is to finish till efficiency ratios, everything. I think after that, you don't have anything else to study. Like 1 or 2 ratios are there. Tomorrow we'll try to maximum, we'll try to wind up all the ratios. And then day after tomorrow, we'll solve this big question. Okay.
Okay, sir.
That is the end of the chapter. So tomorrow's target or agenda is to finish all the ratios. Day after tomorrow, we will do big question. With that, your entire ratios is done. Okay. And meanwhile, I'll send you the first chapter videos. Shall I send you?
Yes. Yes, sir. Yes.
Okay, Hamsika. Whenever you are free, you can watch that. I'm sending you the first
Yes.
chapter video.
Yes, sir. Okay, sir.
Okay, Hamsika. Thank you.
Yes, sir.
You.
Thank you, sir.